welcome you back to another episode of Tales of Logistics. And this week, our discussion is focusing on the frictions of cross-border payment in trade. Every single day, we have manufacturers in various parts of the world that are buying and selling. For instance, we have manufacturers in Germany that pays suppliers in Korea. We have retailers in Canada sourcing goods from China, and logistics companies in the US settle invoices with partners in various parts of the continent. But when an average Joe hears this, it sounds so simple to him or her because in his mind, you ship the goods, you pay, and then you move it. That's all. But no, it's way more complicated than that. Why? Because the moment money crosses borders, a new kind of supply chain begins. A financial kind of supply chain that is filled with unpredictable exchange rates, business days to clear out a payment that can be from 2 to 5 working days, and compliance checks that often stalls payment and hidden fees that even these global traders don't notice until when it's late. But what are the real causes of these frictions in cross-border payments? What are the impacts of these cross-border payment frictions? And what is the future of these cross-border payments? Starting with the real causes. The foremost real cause of cross-border payment friction is the currency itself. Currency risk is the number one invisible tax on global trades. Here are 2 relatable examples that any trader listening to me can relate with. A US importer buys inventory from a supplier in Japan. Between when the invoice was issued and when the payment transaction was concluded, the USD has dropped by 1.8%. That drop of 1.8% definitely would eat into somebody's profit margin. If we want to go to Europe, a German machinery exporter who signs a contract in USD to a buyer in California. Before the payment was done by the buyer in California, the euros has gained against the dollars, and that shrunk the profits for the German machinery exporter. So globally, exporters, importers, manufacturers, retailers, traders are losing billions annually owing to this unnoticed volatility that disrupts the ecosystem where we have exchange rates that move so fast in a minute, while the invoices move by a week. A clear mismatch that is killing cross-border trade. Banking delays is also part of it. Banking delays kills and affects cross-border payments a lot. It takes 2 to 5 business days in North America, Europe, and Asia in traditional banks to conclude a payment. And if unfortunately that transaction has to go through compliance reviews, it takes longer. If it has to go through several intermediary banks, it takes much longer. So a shipment can literally get to New York from Rotterdam faster than a payment wire transfer. Why? Because of all the delays that will occur owing to traditional banks. Delays that would disrupt and affect cash flow negatively, that would affect inventory cycles negatively, and even hurt the payment credibility and ability to negotiate early payment discounts. From Canada to EU, from US to China, from Singapore to EU, there are several sanctions and AML rules that needs to be applied by the banks. And the banks are usually terrified by violating any of the sanctions because it will lead to requesting for extra documents. Payments will be on hold. There will be unexplained manual review delays. And sometimes payments will have to be returned after days. So for businesses, this unpredictability equals real financial losses. And we can put this in better context in one example here. For instance, say a Canadian retailer who ends up losing money on Chinese export because he signed a contract, a 45-day payment cycle with an exporter in China. By the time the payment was made, the currency fluctuations erased 3 to 5% of the expected profit. Now, when you multiply that by 12 months, it becomes a 6-figure problem. If you have an agreed payment cycle with a client and your payment is on hold, it will definitely affect the agreed upon transaction. So the impact leads to billions of dollars getting lost annually. But how much is this loss? Let's talk about the first one, FX conversion spread. When a bank decides to widen an FX conversion spread by 2 to 5%, it can cost businesses a lot. Say, for instance, the bank widens an FX spread by 2 to 5%, and you're to pay $300,000 a month for a transaction. That's a $6,000 hidden fee each month. Besides that, you also have delayed payment settlements that usually disrupt supply chain, delayed shipments, storage fees, demurrage, and loss of early payment discounts. So these are some of the silent losses that businesses or traders experience in cross-border. Some of them are so little, like having a wrong SWIFT code or a missing beneficiary address, that little mistake can send that payment into a 3-day loop of returns and reprocessing. And of course, we have compliance frictions because certain jurisdictions are flagged as high risk by Western banks. Payments involving China, India, Turkey, and parts of Southeast Asia often face extra scrutiny. In Africa, like Nigeria, these are countries that also face extra scrutiny and are tagged as high risk by Western banks. So if you have a transaction or a payment coming from those parts of the world, just know that there will be delays owing to compliance and AML issues. So we've mentioned the losses that are caused owing to FX conversion spread from delayed payment settlements or from a little mistake as a SWIFT code. Then we also talked about the causes of these cross-border frictions. But the main question, and anyone will ask, is this: what are the solutions to these causes, to these problems, and how can it be fixed to help make trading across border easier and better? Over time, fintechs, or what we call financial tech platforms, has sprouted or have increased globally. These fintechs or financial tech platforms offer near real-time settlements, lower FX spread, transparent fees, automated compliance checks. We use them daily. This is in addition to dashboards that they also have. The dashboards allow exporters and importers to track payments like they track the parcel from Amazon, to know who's holding the payment, where the payment is stuck, what needs to be cleared, what fees are deducted. So the fintechs are doing a lot. They've come a long way. They keep improving. They keep helping with cross-border trades. And not just businesses, even individuals have benefited from it. Who wants to send money to a different country have benefited a lot from it. Some cases takes few hours, some others take a couple of days, but the hiccup involved with traditional banking is not experienced when you use fintech platforms. Then there is the automated FX hedging tools that has helped businesses to lock FX rates for 30 to 90 days. These automated FX hedging tools allow them to auto-execute trades when the rate hits targets or avoid margin hitting fluctuations. So this FX hedging tool, along with the fintechs that are increasingly coming out in this supply chain industry, in the part of financial services, has done a lot of good and a lot of ease on international trade or on cross-border payment. That's not all. Even transaction settlements have been reduced a lot. It has reduced a lot because of API-driven payment platforms, while increasingly connect cross-border payments and businesses. So these discussions have shown us the real causes, have shown us the losses that's affecting the business, and have shown us some of the things that the industry is seeing when it comes to advancement and development in international trade and cross-border payments. But what are the pieces of advice for businesses that usually involves in cross-border payments? My first piece of advice is this: Never agree to cross-border deals without a currency risk clause. The invoice can state that the payment should be done in your own home currency, or find a way to build a volatility buffer if the payment will not be done in your own home currency. And if you have clients that are in various countries, continents, it would be ideal to have business accounts that are tailored for that particular currency. What I'm trying to say is that use multiple currency accounts. So if, for instance, you have a lot of transactions occurring in Europe, or you have a lot of clients in the US or in Canada, it would be ideal to have a USD account or a CAD account or a Euros account, because it's easier. Having an account in such currencies makes FS so much favorable for you. You don't have to deal with exchange rates, fluctuations, and payment is faster because the currencies are in the same. And you should not also rely on one bank. So you should have a bank, a traditional bank, and a fintech platform account. All you need to do is constantly check which of them is cheaper, faster for your transaction. That way you're saving time, you're saving costs, and you're saving money for yourself. And if it's possible for your suppliers to give you a local collection account, it will remove 70% of cross-border friction so that payment can be done locally. By giving you a local paying account, it reduces the burden that would involve in bank delays, compliance issues, settlement time periods, or if you come from countries that the Western banks consider as high risk. And finally, don't forget to create a monthly FX loss report. That way you can know how much money disappears, what financial platform the money disappears from, and from where. That information or that knowledge will help you know what to avoid and how to reduce your expenses. Yes, cross-border payments are the bloodstream of global trade. As logistics, manufacturing, e-commerce, and supply chain moves faster, the money flowing between them should move at the same speed. And with smarter tools, better visibility, and modern infrastructures, exporters, importers, and logistic operators can definitely regain control and save the industry a lot of hiccups, bottlenecks, and burden. This is how we end our episode for this week. Please share, subscribe, leave your reviews with me, and I'll catch you guys again next week. Voila.